I want you to lean in for this, because what I'm about to describe didn't just happen in a backroom crypto forum or obscure thread. It happened today, under the glare of global finance. The world's largest stablecoin, USDT, just earned formal multi-blockchain regulatory recognition from the Abu Dhabi global market. And I'm not talking about a token whitelist or optional sandbox status. I mean institutional-grade legal clarity. USDT is now an accepted fiat reference token, AFRT, valid across a broad set of major blockchains. Hear me, this isn't small. This moment might be one of those rare inflection points where crypto shifts from niche speculation to legitimate global finance rails. And if you're watching from Africa, from Lagos to Nairobi, this could hit harder and faster than you expect. Because when stablecoins get legitimacy at the highest regulatory level, it isn't just about markets, it becomes about money, trust, and access. Brace yourself, because what started as a headline could evolve into a financial shift that reshapes how Africa, the often underserved, underbanked, underserved, moves money, stores value, and builds generational wealth. Let's walk that path, step by step.
On December 8, 2025, the Abu Dhabi Global Market, ADGM, one of the most respected financial regulators in the Middle East, officially granted AFRT status to USDT. Now that sounds technical, but here's the simple translation. ADGM basically said, yes, USDT counts as a legally recognized fiat reference token within our system. That alone is huge. But the twist? They didn't just approve USDT on the usual big networks like Ethereum, Solana, and Avalanche. They extended this recognition across 9 more blockchains: Aptos, Celo, Cosmos, Kaya, Near, Polkadot, Tezos, Ton, and Tron. 9 networks in one stroke. Why does that matter? Because it doesn't just give USDT more places to live, it gives institutions more ways to legally use it. Under ADGM's umbrella, licensed custodians, exchanges, payment processors, and even banks can now handle USDT across all these chains without worrying about stepping outside regulatory bounds. Imagine a bank settling a transfer using USDT on Tron, or a payment company routing remittances on Celo because fees are lower. That's not just convenience, that's transformation. Here's a scenario to make it real. Think about how people use USDT today in countries with unstable currencies. They send money, store value, avoid inflation. But they do it through platforms that regulators sometimes tolerate and sometimes don't. Now imagine those same actions, custody, transfers, deposits, happening through institutions that are fully licensed and fully compliant. Suddenly something that felt underground becomes something you could explain at a board meeting. But let's be honest, USDT wasn't always welcomed with open arms. For years, it operated in a gray zone. Everyone used it, traders, remittance senders, arbitrage desks, but institutions hesitated because compliance departments hate uncertainty. This ADGM approval changes that dynamic. It doesn't mean USDT becomes risk-free, but it removes one of the biggest obstacles, regulatory ambiguity. And in finance, once compliance risk drops, institutional participation almost always rises. It's like turning on a green light after years of flickering yellow. USDT didn't just pass a technical test across multiple blockchains, it passed a jurisdictional test, a test of whether a global financial authority sees it as legitimate enough for regulated use. When a major jurisdiction legitimizes a stablecoin across 9 networks in one move, you can feel the industry shift a little, because that's not just approval, that's an invitation.
Let's be honest, what ADGM just did isn't only about Abu Dhabi or the UAE. It's a message aimed straight at the global financial system, like a quiet but confident announcement. Stablecoins aren't fringe anymore. They belong inside regulated finance. And when you zoom out, the pattern becomes impossible to ignore. Throughout 2024 and 2025, regulators across the world tightened their frameworks around stablecoins, not to kill them, but to shape them. Governments issued guidelines. Exchanges rushed to update documentation. Issuers scrambled to meet new compliance expectations. It was like watching a messy industry suddenly being asked to put on a suit. So when ADGM steps in and gives its blessing to not just USDT, but also RLUSD, Ripple's own stablecoin, that's not a coincidence. That's a signal. Regulators aren't just regulating, they're mapping out crypto's next chapter, quietly, deliberately, and always with an eye on institutions. And institutions are absolutely paying attention. Think about banks, remittance operators, international payment firms. These are groups that move billions every day. What do they care about? Speed, reliability, cost efficiency, and maybe above everything, compliance clarity. Stablecoins already offer the first 3. That's the settlement, sheep transfers, programmable money movement. But until recently, they lacked the last one, regulatory cover. And without that, big institutions stay on the sidelines. Now imagine you run a global remittance company. You've been watching stablecoins eat into your margins because people are sending money home for pennies instead of paying your $12 transfer fee. But you couldn't adopt stablecoin rails because regulators weren't clear. Now a major jurisdiction says, go ahead. It's legal. It's recognized. It's supervised. Would you ignore that? Of course not. No rational business would. This is where things get exciting and honestly a bit surreal, because this shift could completely change how global payments work. Right now, cross-border transfers rely on SWIFT messages, correspondent banks, FX corridors, and outdated settlement windows. Money hops from one institution to another like a traveler catching connecting flights. Sometimes it gets delayed, sometimes it gets flagged, and almost always it gets expensive. Stablecoins flip that whole system. Instead of messaging money, you move money, instantly, 24/7, across borders, with finality built in. Picture a supplier in Kenya receiving payment from a buyer in Dubai in seconds, not days. Picture remittances settling in real time. Picture small businesses tapping global markets without paying half their profit to banks. That's the shift ADGM is hinting at. This isn't crypto culture anymore. Not memes, not speculation, not hype cycles. This is finance infrastructure evolving in real time. A new set of rails being quietly laid down beneath the old financial system. Once those rails are in place, the trains that run on them, the institutions, the businesses, the everyday users, will follow.
Let me put this in plain terms. For DeFi and SocialFi builders, what just happened might be one of the biggest turning points we've seen in years. And I don't say that lightly. I've watched this space long enough to know that hype cycles come and go, but structural shifts, those are rare. And this one is structural. One of the core problems DeFi has struggled with since the beginning is what I call the portal problem. How do you move cleanly from fiat into crypto and then back out again without running into compliance issues, high-risk platforms, or expensive intermediaries? Everyone talked about decentralization, but when users wanted to cash out or institutions wanted access, the bottleneck always appeared at that transition point, the on-ramp and the off-ramp. Now imagine removing half of that friction in one regulatory move. That's basically what happens when USDT becomes legally recognized and institution-friendly across so many blockchains. Suddenly, liquidity isn't just deep, it's compliant. You don't just have stablecoins, you have stablecoins that institutions can legally touch, hold, settle, and custody. And when that happens, DeFi stops being a shadow financial system and starts looking more like a parallel open one. Think about a lending platform where deposits aren't just crypto-native money, but USDT that regulated entities can support. Or stablecoin savings vaults where the underlying asset is recognized by financial authorities. Risk models get cleaner, liquidity becomes more predictable. Builders can design systems without worrying about regulators might pull the rug from under them. Now shift the lens to SocialFi, where value exchange is far more emotional and immediate. Picture creator platforms where payouts aren't speculative tokens or volatile governance coins, but a stable, regulated USDT-pegged asset. Imagine tipping systems, micropayments, community rewards, or marketplace settlements running on a currency that's instantly recognizable to a global audience, not just crypto-native users. That's how you bridge the gap between crypto people and regular people. The moment users don't have to understand tokenomics or volatility to participate, everything changes. A TikTok creator in Brazil, a designer in Nairobi, a gamer in Vietnam, they all understand what a stable dollar is. Now picture them receiving one instantly, trustlessly, across borders. From the cycles I've studied and the adoption curves I've tracked, these are the kinds of moves that create genuine product-market fit at scale. Not because of hype, but because the underlying infrastructure finally aligns with how people actually behave. This isn't just good for DeFi and SocialFi. This is the moment the ecosystem starts feeling usable, not experimental. And that's when real adoption begins.
Let's bring this closer to home. If you're in Lagos like me, or maybe Accra, Nairobi, or Johannesburg, this isn't just some far-off global trend we read about online. This is happening now. It's immediate. It's practical. Why does it matter? Well, Africa is fast becoming the epicenter of stablecoin adoption. Take Nigeria, for example. Between July 2023 and June 2024, nearly $22 billion in stablecoins moved through the country. Let that sink in. That's almost half of all crypto activity in sub-Saharan Africa. That's not a small number. That's huge. People aren't just dabbling, they're actively using stablecoins. And who's using them? About 25.9 million Nigerians are engaging with digital assets. That's roughly 12% of the population. Think about that for a second. Globally, few countries can claim leadership in stablecoin adoption, and Nigeria is right there, leading not just in Africa, but in the world. So why the surge? Why are millions of people turning to stablecoins? Because they solve real problems. Imagine waking up one day and your local currency has dropped in value, or inflation has eaten away your savings. Stablecoins offer a lifeline. They protect against currency devaluation, inflation, and foreign exchange scarcity. They make sending money across borders faster and cheaper, acting as simple rails for remittances and cross-border payments. For many, stablecoins aren't just speculative tools. They're a store of value, a shield against economic uncertainty. Now, let's layer in something even more exciting. The Abu Dhabi global market recently announced a globally recognized stablecoin with clear legal frameworks, and it can operate across multiple blockchains. What does this mean for Africans? It opens doors for compliant on-ramps and off-ramps, the gateway to safely converting your local currency to crypto and back. Imagine remittances, cross-border trade, and diaspora transfers becoming faster, cheaper, and more secure than ever before. For millions of unbanked or underbanked Africans, this isn't about speculation or chasing profits. It's about access, stability, and choice. It's about having control over your money in an environment where traditional systems often fail. Are we ready to embrace this reality? Because stablecoins are no longer just a financial experiment. They're becoming a lifeline, a tool, and a game changer for everyday life across Africa. And if you're paying attention, they're not just shaping the future, they're shaping the now.
Look, I don't want to make this sound like some perfect utopia, because every big shift, every innovation comes with friction, risk, and real downsides. And stablecoins, they're no exception. First, let's talk about centralization risk. Take USDT, for example. It's issued by a single company, Tether. Now imagine institutions adopting it en masse under regulated frameworks. On the surface, that sounds safe, right? But the catch is that centralization creates a single point of failure. If Tether faces legal issues, liquidity problems, or compliance hurdles, the ripple effect could destabilize every system depending on it. Suddenly, what was supposed to be stable could become fragile. Next up is exclusion risk. Just because something is regulated doesn't automatically mean it's open to everyone. ADGM's framework applies to licensed firms. But what about the millions of people who operate outside formal financial channels? DeFi users, peer-to-peer traders, informal remittance networks, especially in Africa where these networks are lifelines for cross-border money movement. Institutional compliance could unintentionally reinforce centralization instead of promoting access. So while regulation brings security, it might also leave some people on the sidelines. Then there's the matter of dollar dependency and monetary sovereignty. Most of these stablecoins are pegged to the US dollar. That means capital flows in dollar terms, not local currency. For countries already struggling with inflation or currency volatility, this can weaken the role of the national currency and complicate monetary policy. Basically, the more people rely on USD-backed stablecoins, the less control local governments have over their own economies. And finally, let's consider regulatory backlash or geopolitical exposure. As stablecoins become more embedded globally, governments may push back. Think clampdowns, capital controls, or sudden policy shifts. Cross-border flows that once seemed seamless could suddenly face restrictions, creating instability in markets that depend on these digital rails. The opportunity is massive. Stablecoins can make remittances faster, reduce friction, and even protect savings from local currency volatility. But the risk is real. Centralization, exclusion, dollar dependence, geopolitical pressures, these are not theoretical, they're very tangible. The point is, we have to approach this with both eyes open. Celebrate the potential, but understand the limits. Ask the hard questions, weigh the trade-offs, and plan for the scenarios where things don't go perfectly. Because in finance, especially at this scale, ignoring risk isn't just naive, it's dangerous.
Looking ahead, I see a few possible paths for stablecoins over the next few years, and each one could reshape how money moves across borders. Let's walk through them. Scenario A, rapid institutional expansion. Imagine more countries following ADGM's lead, maybe other GCC economies, Africa's big financial hubs, or even Latin America. Suddenly, regulatory approval isn't just a buzzword. It cascades across borders. Banks, fintechs, remittance firms start officially offering stablecoin services. What does that look like? Well, stablecoins could become a parallel global payment rail, moving money faster and cheaper than traditional systems without having to wait days for transfers or deal with expensive fees. Scenario B, African fintech surge. Now picture local fintechs in Lagos, Nairobi, or Accra partnering with regulated stablecoin issuers. Compliant on-ramps and off-ramps appear everywhere.
Small businesses start paying suppliers in USDT. Remittance corridors go fully on-chain. Cross-border trade becomes smoother. For the first time, stablecoins move from niche crypto tools to everyday business utilities, helping people transact reliably across countries. Scenario C, hybrid finance integration. Here's where traditional banks get creative. They start offering tokenized deposits, stablecoin-backed accounts, or bridges between fiat and crypto. Especially in places where local currencies fluctuate wildly, stablecoins could become a lifeline, a way to store value safely while staying connected to the formal financial system. Scenario D, regulatory pushback or fragmentation. Of course, not every country will be on board. Some may resist, enforce capital controls, or clamp down on stablecoins. Others might push their own national crypto or CBDC alternatives. If stablecoins start to challenge monetary sovereignty, governments might react strongly. It's a reminder that innovation rarely happens in a vacuum. Policy always matters. E, user-driven DeFi growth. Finally, even outside institutional or regulatory frameworks, grassroots communities could adopt stablecoins en masse. Freelancers, online workers, diaspora remitters, everyday people might start using USDT and other stablecoins as routine money for millions, regardless of banks or regulations. Each of these paths carries uncertainty, and maybe some will overlap. But here's the key takeaway. USDT's growing legitimacy changes the odds dramatically. What was once just a tool for speculation is now a contender for everyday money, cross-border payments, and business operations. The question isn't whether stablecoins will matter. The question is which scenario or combination of scenarios will shape the next chapter of global finance, and how prepared are we to navigate it?
Having lived through currency devaluations, remittance delays, and the daily headaches of banking inefficiencies in Africa, this development hits close to home. It's not just a story in a news article, it's personal. If I were building a fintech or DeFi product in Lagos today, I wouldn't just be thinking about crypto trading. I'd be thinking about real-world solutions. I'd start sketching out a stablecoin-enabled remittance or payment system. Why? Because people need ways to move money instantly, cheaply, and reliably, not wait days for transfers that sometimes never arrive. I'd partner with compliance-friendly issuers, the ones who can legally bridge local fiat and USDT. I designed everything mobile first, because in Africa, most people bank with their phones, not desktop apps. And I build tools that don't just let you trade crypto, but actually move value across borders, helping small businesses, freelancers, and everyday families. If I were advising friends or family concerned about inflation or currency volatility, I'd say, look at USDT or another credible stablecoin as more than a speculative asset. Think of it like a digital alternative to a foreign bank account. It can protect savings, facilitate diaspora remittances, and make cross-border business payments smoother and cheaper. For millions living in countries where local currencies lose value quickly, this isn't just convenient, it's practical survival. But let's be honest, this isn't magic. Stablecoins are useful, yes, but they're not risk-free. Regulation can change, institutions can run into compliance problems, geopolitical shifts can suddenly limit access. So I'd caution anyone, don't put all your eggs in one basket. Diversify, hedge, stay informed. Use stablecoins as one tool in a broader strategy to protect and move your money. Because here's the reality. Stablecoins are no longer just for crypto enthusiasts speculating on price swings. They're about utility, access, and opportunity. They're about giving people in Africa and elsewhere more control over their money. They're about moving value in a world where traditional banking often falls short. The question isn't whether stablecoins are relevant. The question is, how do we use them wisely? How do we build systems, businesses, and personal strategies that take advantage of this new financial reality without ignoring the risks? And that's where real impact starts.
So here's where we land. At the edge of something big but undefined. USDT just got a major regulatory green light in Abu Dhabi. That's a fact now. But what will ripple from that? Will traditional banks globally and in Africa quietly adopt stablecoins as part of their rails? Will remittance corridors shift on-chain and cut costs dramatically? Will stablecoin-based savings and business treasury tools replace Naira volatility hedging? Will regulatory frameworks across Africa evolve fast enough to support this transformation, or will some governments clamp down to preserve currency control? And ultimately, will this change bring financial inclusion, empowerment, and stability, or will it exacerbate dependencies, centralization, and systemic vulnerabilities? I don't know the full answer yet, but what I do know is this. We are at the start of a major shift. And in the coming months, the real story won't be on-chain metrics or market caps. It will be in people's lives, businesses, remittances, and daily financial decisions, especially across Africa. So stay tuned, because this isn't just crypto news. This might be the beginning of Africa's most consequential financial chapter in decades.
I've got more interesting videos in the card above. This is blockchain money.